Welcome to the Onchain Risk Map launch webinar. We will get started in a few minutes and introduce the Onchain Risk Map, which is both a practical tool and a framework for understanding, categorizing, and navigating on-chain risk. I'll just make sure that the technical setup is complete, and we will wait a few minutes before everybody is here. Thanks for your patience. Yeah. Okay, I think we are ready to get started. Everything is looking good on the technical side of things. Hello and welcome to the On-Chain Risk Map launch webinar. On-Chain Risk Map is both a practical tool and a framework for understanding, categorizing, and navigating on-chain risk. Today we'll walk through the On-Chain Risk Map in detail. We'll talk about how it's structured, what the main risk categories look like, and how this initiative came together. I am Sam. I lead community efforts at Nexus Mutual DAO, and I contribute to the On-Chain Risk Map. Joining us today are Jeremiah, CEO of OpenCover, and also a contributor, and Ricky, another contributor, CEO of Nexus Mutual. Welcome both. The On-Chain Risk Map is a public good for DeFi participants to understand, categorize, and navigate on-chain risk. This year, in collaboration with OpenCover, we at Nexus Mutual built the first version of the map and the report that accompanies the map. I'm excited to show you how it works, how it looks like, and demo the website together. But before, I want to talk with Jeremiah and Ricky. Jeremiah, let's start with you. Would you like to introduce yourself and talk a little about the map?
Yeah, for sure. Thanks, Sam. Thanks, everyone, for tuning in. I'm Jeremiah, co-founder and CEO at OpenCover. We specialize in DeFi risk transfer, focusing specifically on complex and embedded use cases. So things like covering blockchain transactions or DeFi vaults. We're part of the Nexus Mutual, I guess, and lead one of the syndicates there. So long story short, we've been building on the Nexus Mutual protocol for some years now. And we also work closely, of course, with the Nexus Mutual team to create, underwrite, and distribute new risk transfer products, embedded products, etc. And that's sort of how we got to the on-chain risk map. We realized that our industry has no sort of common language, no framework to really understand, identify, and manage on-chain risk. And that I think is the main motivation behind the on-chain risk map, which is effectively a taxonomy of blockchain risk. It's divided into 6 main categories that we'll talk about a little bit later. And yeah, it's a framework that's free for anybody to use. It is designed for more of a sort of institutional audience, so risk professionals, sophisticated market participants, and industry stakeholders. And yeah, basically we've created this the framework we thought was missing for to tackle on-chain risk rigorously.
Thanks, Jeremiah. Ricky, over to you. A few words about yourself and the risk map, please.
Hey everyone, thanks for joining us today. So I'm Ricky, I'm the CEO at Nexus Mutual. Really excited after a few months of working with this, working on this together with the OpenCover team to basically launch something that, we think is just like really necessary and also a common good for the broader crypto and digital asset space. I just want to reiterate, so the Onchain Risk Map is essentially like this collaboration between Nexus Mutual and OpenCover. Nexus Mutual being the first crypto insurance alternative. We've been live since 2019, and OpenCover being one of the syndicates that works on top of Nexus Mutual and is really just like at the forefront of how insurance-like products and risk protection gets implemented across DeFi and now increasingly so traditional insurance. I also just want to stress to everybody out there, or if you end up listening to this webinar after it's being recorded, that this isn't just like a report. Obviously, there's a PDF that goes around, but there's also an interactive website that Sem will show to everyone. And more importantly, we hope that this is just the beginning of a dialogue and maybe one day like a very broad industry group in which people from all across crypto and finance can come together to essentially create the common language and understanding of all the different crypto risks. The goal ultimately, of course, is to raise awareness, get everyone to speak the same language, and most importantly, just to build together. Over to you, Sam.
Thanks, Ricky. Very well summarized. And also thank you, Jeremiah. Just one more thing to reiterate before we go into the demo. Jeremiah, why does DeFi need an on-chain risk map?
Yeah, I guess that's a very good question. So obviously, it's no secret to anyone watching this webinar that blockchain, crypto, DeFi, however you want to call it, is a major shift in financial infrastructure. And so obviously with new technology comes new risk. Zero risk does not exist off-chain. It doesn't exist on-chain. It will not exist on-chain. And we think that's why we need this common language, this common framework to identify and be able to manage risk in a rigorous or a structured way. I think, historically, for many early participants in blockchain, the relationship to risk was more like, oh, it's part of the game, like I made a lot of money on whatever coin and lost some money because of whatever hack. And that's just like how things work in this industry. But now, like 15 or so years later, I think that level of sophistication just like doesn't cut it. The industry is maturing, the infrastructure is maturing, the participants are maturing, right? Like banks are coming on chain, etc. So really now is the right moment to formalize a lot of things, from sort of regulation that, that's an effort that's been going on for some time. But also, risk and, how we think about risk, communicate about risk and manage it. And so here we are.
Thanks, Jeremiah. Seems like it's the right time to talk about risk together. Ricky, what do you think?
Yeah, it's really just like picking up where Jeremiah left off talking about how the industry is maturing and there's new entrants, specifically like the institutions that just require like a different style of communication and also like a more rigorous standardization of everything that's happening in crypto and DeFi. It sounds a little bit corny to say the institutions are here, but they are. And a lot of the time they're just asking questions that most people in crypto just don't have standardized answers for. I think over the past 5 to 6 years at Nexus Mutual, that we've had so many different conversations with people from all across crypto, whether that's DeFi natives to now the TradFi allocators. And the one major theme is that, the mental models from traditional finance and the terminology just doesn't map cleanly onto on-chain and DeFi risk. So many of the discussions that we have with institutions simply just start with, can you explain us what this specific risk is? And that's the gap. Like, there's no shared reference point when you talk about crypto specific things such as smart contract risk, Oracle risk, slashing, et cetera, et cetera. And we also see that from the other side of like the crypto native teams, so the builders who create new protocols and primitives. Like, they even struggle with kind of like finding standards of how they describe the risk that they're trying to avoid. So it's really just like there's no shared taxonomy, and ultimately that's why we're here, because if we as an industry want to mature, then we need to find that common ground for just to discuss, first of all, like where to allocate in the industry and how to protect yourself with products that Nexus and OpenCover build together.
Thank you. I think it's a good time to finally demo the interactive map. Just give me a minute until I make sure everything looks fine. I will be sharing my screen and showing you the live website on onchainriskmap.com. And then we will talk about how the risks are structured and deep dive into the main categories. Okay. The website currently live on Onchain Risk Map starts off by talking about what we are attempting to build, with further links down below for the report, which basically translates all the information in the interactive map into a readable format. And we also have links for you to come and join the discussion. But I will go into the map. Okay, so when you open the on-chain risk map, you will see it is version 1.96. Here it is always updated when we have a new versions for the risk map. And it's not version 2.0 yet. We are actively collecting feedback. So if at any point during this session or later while you are exploring on your own, if you have suggestions or if you see areas that could be clearer, please let us know. You can use the share feedback button on the top right to let us know of any feedback. Just below the header, you see the 6 main categories we use to organize on-chain risk: custody risk, protocol risk, staking risk, and then transaction risk, digital asset risk, and systemic risk. Let's zoom in a bit, and I will show you how it looks like in one of these categories. For example, under protocol risk, the next layer is grouped into smart contract exploits, protocol economic risk, governance attacks, and centralization. This categorization has been part of the work that we've been doing with OpenCover. There are many different risk surfaces, and categorizing them into a way that makes sense has been an important field of research and discussion. When you look into protocol risk for smart contract vulnerability, it's all about exploitable coding errors, with examples like the balancer incident. And also we have under smart contract exploits, misconfiguration relates to operational or parameter related mistakes, including cases like the I earn Y. So maybe one important thing to note here, at each risk item, we include some codes at the top left. These are mainly for navigation and so that you can cross-reference with the report. And we also have the examples with links to external websites. These links are again open for discussion. If you come across anything else that you think explains the hack or attack more clearly, we're open to evaluating the feedback and improving the risk map together. You can expand the map to see just how wide the on-chain risk surface is and how wide our documentation is. And again, feel free to explore on your own. There are a lot of links and interesting resources to look into. Now maybe Jeremiah, I wanna talk a little about the use cases that you think the on-chain risk map is good for.
Awesome. Yeah, so I mean, I think the first use case is just for anyone to look at the map, traverse the tree of risk events, and think about if and how the different risk areas and associated risk events apply to whatever whatever you do, whether you're a company, individual, institution. I think there's 58 or so risk events with the examples. So those are meant to really help you understand and identify what's relevant or not to what you do with blockchain. But I think more broadly, what we're hoping to achieve and the use cases we're hoping to create is, I think, first raising awareness for on-chain risk, just in general in the industry, because it's not something super well understood, as Ricky said, and there's no kind of common standard for it. And then give industry participants a tool, a framework to really identify and communicate and manage on-chain risk rigorously. So anything from sort of treasury managers, founders, operations teams, etc., or even people who want to join the industry. So say, traditional insurers who might not have the full expertise or experience with blockchain risk, and then need a sort of framework to help them navigate. And then finally, as we said, it is a common good. So we hope to drive contributions, and we'll continue, of course, to map new risks as they emerge in the space, like crypto agentic flows and so on. So I think those are the main use cases that come to mind.
Thank you. Maybe let's start introducing the main risk categories on the map. Jeremiah, let's continue with you.
Cool.
About custody risk and transaction risk, any highlights and notes that you want to share?
Yeah, I mean, I think custody is sort of the fundamental risk of digital assets. It's how you keep your assets, safe. And the main two categories or kind of subcategories are self-custody, which is when you decide, I'm fairly certain everybody on the webinar knows, but is when you decide to have direct physical control of the private keys that allow you to sign transactions to move your assets directly on the blockchain. And third-party custodian risk, so when you decide to delegate the Are we back? Yeah, I think we're back. So third-party custody risk, when you decide to delegate the important job of keeping your private key safe, or keeping your digital assets safe to a third-party custodian, like an exchange. And so then, if you expand into self-custody and third-party custodian risks, Sam, if you want to, like if you can expand both, maybe. Like as in both self-custody risk and third-party custodian risk. Yeah. So really, it's pretty much the same risks conceptually, or very similar risks. If you're doing self-custody, you got to be careful that nobody steals your private keys, or that you do not yourself lose them. And similarly, when you're trusting a custodian with your assets, you want to make sure that nobody steals your credentials to access the assets with the custodian and do something naughty. And you also want to make sure that the custodian doesn't fail for technical or legal reasons. So I think it's probably not worth diving into every single sort of risk event there, but you should totally, we invite you to sort of explore yourself. And as Sam mentioned, the gray bar on each risk event, so at the bottom of the tree, the leaf nodes of the tree, are real world examples that illustrate exactly what, or one instance of the risk materializing, quantifying it, and showing the cause. If we go to transaction risk, there again, I think there's two sort of top level risks. The first one is really, signing the wrong thing, as in signing a malicious transaction. So interacting with a malicious smart contract, for example, either because the interface you're using to create the transaction has been compromised, or because the smart contract itself, you're interacting directly with a smart contract that is kind of obfuscated but malicious. And then the second risk category for transactions is legitimate transactions, but that have unintended economic outcomes. So recently, I think there was one of these sort of on-chain yield aggregator platforms where they were doing a legitimate transaction, but they were subject to large slippage, which went unchecked, and they lost millions of dollars on a slippage event with a legitimate, doing a legitimate transaction with a legitimate smart contract on the blockchain. So it just illustrates that part of on-chain risk is kind of being careful with bad actors, but another part is also being careful with your own sort of what you sign and how you keep your assets safe if you're doing self-custody.
Thank you, Jeremiah. I'll move forward with the protocol risk section of the on-chain risk map. So as we know, DeFi protocols cover a wide range of on-chain financial services, and many of them are open source, and that is great for peer review for the wider industry as well. But it also means that attackers can study the code, look for edge cases, and exploit weaknesses once they're found. And protocols often come together and are made up of multiple smart contracts, each at their own attack surface. And protocols also often depend on other protocols or third-party components. So the complexity just increases, and also the probability of loss increases. As we have seen, even long-standing battle-tested protocols can be compromised through integrations and dependencies, and it may not just be flaws in their core logic. Currently on the on-chain risk map, protocol risk has 4 subcategories. In smart contract exploits, which I had showed earlier, we cover smart contract vulnerability and misconfiguration. In protocol economic risk, we include Oracle misconfiguration, Oracle failure, Oracle manipulation, and also liquidation failure. So these are more related to Oracle data and protocol design. In governance attacks, we cover voting manipulation, hostile takeovers, and malicious source code upgrades, which seem similar in nature, but has different nuances in how the control is captured in the decentralized decision-making landscape of the protocol. And lastly, centralization includes rug pulls and compromised operations wallets, which basically all point to single point of failures and centralized control points. Ricky, over to you for digital asset risk.
Yeah, I just want to pause here, and I just hope that everybody kind of realizes that this is such a good visual representation of, when people think that they talk about one specific risk, there's actually not one risk, but as Sam already showed you, there's in the 3 categories that Sam and Jeremiah have just explained, that's already like 50 different sub risks. which also just shows that if you're building cover products and insurance-like products in this space, like this is all the stuff that the Jeremiahs, Sems, Rickies, and OpenCover Nexus Mutual people think about. So yeah, I just love the visual representation. All right, let's dig into digital asset risk. When we were putting this together, we really just we thought, well, let's just make one category which we call digital asset risk, and it's just very all and like it just includes everything. So cryptocurrencies, tokens, stable coins, NFTs, they're just like all this new emerging asset class where price behavior is often significantly more volatile than traditional financial assets, but the reasons that drive the volatility are actually often the same as in traditional financial assets. Where the first digital asset risk that we kind of highlight is liquidity risk, which is simply the risk that you can't convert your asset without taking massive hits on its value, i.e. you're taking a lot of slippage. In traditional markets, this is kind of like what people worry about with smaller, small cap stocks, etc. In crypto, we have seen this multiple times again, that this can happen to even the largest tokens almost overnight. The best example being FTT, which was the token that was associated with the now bankrupt exchange FTX, where when FTX went bankrupt, I think FTT went from $22 or something like to sub $5 within the span of a day, wiping out billions in market value. So if you were holding this token at the time and needed to exit, good luck. The liquidity simply wasn't there. Now, if we move to the second category of stablecoin DPEX, this is one of the things that, especially in recent months with the exponential growth in stablecoins, has been something that we've been talking to with industry counterparties and clients, but there is not one type of stablecoin DPEG. That's something we want to be very clear and honest about. The first type of DPEG is basically like the fiat-backed stablecoin DPEG. So even if you think you're quote unquote safe because a stablecoin is backed by real dollars sitting in bank accounts, even USDC, which is one of the largest stablecoins in the world, like it DPEG'd during the Silicon Valley Bank crisis in 2023, simply because an old-fashioned bank run happened on Silicon Valley Bank, and people in the digital asset space were fearing that part of the USDC deposits would potentially not be redeemed, and as a result, it DPEG'd for a while before it came back to parity. Moving to the right, there is then crypto collateralized stablecoin DPEGs. Here you have to think about stuff like the stablecoins by projects such as MakerDAO or Sky. These are basically stablecoins that are linked to baskets of crypto collateral or even baskets of crypto and other stablecoins, where it's simply where if there are large market movements, these stablecoins tend to, in most cases, temporarily DPEG simply because the underlying basket is not trading at value anymore. We saw this in, I think, March 2020 when MakerDAO suffered a pretty big like a pretty big liquidation event on its platform, and as a result, the DAI stablecoin at the time DPEG'd significantly. This actually happened recently as well, where we had to pay out $100,000 to users affected by essentially liquidation failures that happened across DeFi, which affected their stablecoin deposits. And moving on to the last category, namely algorithmic stablecoin DPEGs. This is the crypto Wild West. The best example here is the Terra Luna event of 2021. Yeah, it was 2021, where these are basically stable coins that are backed by just underlying utility tokens. And in the case of Luna, Luna and Terra USD, this stable coin turned out to be not very stable and just went from parity to zero within the course of a day, simply because the underlying basket of crypto collateral couldn't hold. So yeah, that's everything for the stablecoin DPEX. And if you move to the last category of digital asset risk, we call it wrapped asset DPEX. Although in name it's also a DPEG. What we kind of mean with this is like, this is something that's often overlooked. For example, if you look at wrapped Bitcoin or wrapped BTC, essentially it's a, Bitcoin does not have its own smart contract layer, yet it is being traded on other chains such as Ethereum, because it's being tokenized through essentially deposits on custody platforms. And essentially what a holder of the wrapped version of Bitcoin, i.e., for example, wrapped Bitcoin, essentially the risk that you're being exposed to is custody risk. So even if there is any worry that the custodian might go under, you could see that the wrapped version of a cryptocurrency will trade away from its native version, which is, in the case of wrapped BTC, we saw this following FTX's collapse back in 2022. And then we move to another category, and this is very crypto native. And at Nexus, we actually get a lot of questions about this, like, oh, can you guys help us protect against staking risk? Again, staking is one of the things where there's not one type of staking risk. So first, we start with the proof of stake staking risk, which is what most people actually mean when they say, can you explain what staking risk means? And it's essentially the number of risks that are native to any of the point of proof of stake consensus blockchains such as Ethereum, Mainnet, L1. I'm not going to dig into each and every one of these, but first of all, there's slashing, which is basically the penalty for validator misbehavior, and there are several subtypes that are that people can dig in, such as double signing, where a validator signs two different blocks. There's the surround vote, which is when a validator makes an attestation that surrounds a previous one, and then there's double vote, which is basically similar to double signing, but it's related but not exactly the same. So that's all slashing. And then you move kind of like to penalties, which are these are different from slashing, but people often confuse them with slashing. But the biggest difference is like the penalties can accumulate over time. So if you're a validator and you miss your duties, you basically get penalized by the network. Extended downtime, for example, is one example of this. So those are kind of like the main things that people are worried about when it comes down to, for example, Ethereum. And then there's this other category of staking risk, which we call liquid staking risk. And this is basically where it gets really interesting for the quote unquote hardcore DeFi users, because liquid staking risk is very related to kind of like DPEG risk, but this is when a essentially liquid staking token, i.e. a rehypothecated staking position, starts to trade away from its unstaked counterpart. The best example being that the liquid Ethereum staking tokens such as STETH have shown small periods of essentially a liquidity crisis, and as a result started to trade away from the underlying native asset. And then the last one in this category is really the restaking side. I think it's is that on the right, Sam? If you move to the right. Yeah, on the restaking side, where you have, this is like the latest frontier in crypto. Protocols like Eigenlayer and Symbiotic allow you to essentially rehypothecate the already staked capital another time to secure additional services. And very similar to how slashing can occur on the first layer, it can happen on the restaking layer, where if a protocol or a project that gets backed by this restake capital incurs losses, then the restake capital will trade away from the staked capital. We're getting kind of like really into the weeds here, so I'll just leave it as is, because if people want to kind of like dig into it, like all the examples are here on the website and in the report.
Thanks, Ricky. Before we wrap up, I just want to also highlight one last category that we have here, and that is also open for your feedbacks. And that relates to systemic risk. It's about blockchains and distributed participants that we rely on to validate transactions and maintain a shared ledger through consensus mechanisms. And we have the 51% attack here. It's about when a single actor or a coordinated group acting as a single actor controls the majority of validation power. We also have consensus failures in here, where the network struggles to agree on a state, and leading to stalled blocks, chain splits, and all that. And we also have chain forks and reorganization. And a famous example here is the DAO hack that's made a split happen between Ethereum and Ethereum Classic. So yeah, this is a lot to digest, and this is a resource that's going to live on the internet, and we continue refining it. So personally, I'm very excited about how a conversation to improve it will evolve over the next coming months and years. I also want to ask Ricky and Jeremiah some last thoughts about how you hope this public good will evolve, and how you hope DeFi users will be able to benefit from it. Ricky, do you want to start?
Yeah, I mean, it's taken a few months for us to kind of like come up, not to come up, but kind of like to synthesize everything in, first of all, in this taxonomy, and then all the different formats. And it really is just the beginning, where we just see this as a dialogue. This is something we at Nexus Mutual and OpenCover do on a day-to-day basis. And this is just another tool in our toolbox to help us educate, especially like the institutional entrance into the space. So honestly, I just hope that this is just something that people, can use as another talking point, either with us or with other people in crypto. And, our door is always open. So if you have any questions, or even if you have comments or suggestions on how we should change some of the language or taxonomy, I think, I encourage everybody just to reach out, and hopefully also to contribute to this at one point in time in the future.
Jeremiah, over to you. Thoughts on the future of this and how you hope this will evolve?
Just echoing what Ricky was saying, like, this is meant as a common language for industry participants. So whether it's directly with OpenCover or Nexus, or like other people using it, that's really just the goal, to set this kind of new standard. I think what I'm personally excited about is just to go even deeper into the taxonomy. So we're talking about, I think, Sem, you showed smart contract vulnerabilities and protocol risk, and that that can mean many things, right? I think for now it's just like a top level a risk event. It's on the left. It's on the left a little bit. Yeah, smart contract vulnerability, but that can be further sort of decomposed into reentrancy attacks, rounding errors, etc. So I think there's still some scope to grow the tree, the risk tree, vertically, but then also horizontally, especially with AI coming up and all the new agentic flows in crypto. I'm fairly certain at some point in the near future we'll have a branch where it's like crypto agent risk or something. but yeah, no, I'm just really happy. We have this V1 or 1.96, and excited for V2 and V3, and yeah, hope to hear from you guys on any feedback that you have.
Thank you. I think we are almost at time, and I am not seeing any questions in any of our channels at the moment. So I think I'm gonna leave it to you, Jeremiah, to wrap up the call and to maybe share one last message with our audience.
Okay, thanks. Yeah, I mean, I think ultimately DeFi is has a lot of potential, but it's also complex and constantly evolving. Still a lot of things to build, still a lot of things to do. But if you are interested in on-chain risk or concerned about on-chain risk, I think, yeah, don't hesitate to reach out. I'd say probably the first thing is just to go on the website, onchainriskmap.com, download the report, and then potentially join this Telegram group that Sam is showing just now. And I'm sure that both the Nexus and OpenCover teams would be happy to help if you have any immediate risk assessment or risk transfer needs. We have an email on the website, which is info@onchainriskmap.com. Yeah, so don't hesitate to reach out. And thank you for joining.
Thanks, everyone.
Thank you. Bye-bye.